most of the time since 1990, the gold to silver ratio has been higher than, let's say, wherever it is. What is it, 75? I might be wrong in the number, 80 something. But whatever it is now, it's been higher than the 200-week moving average for like 95% of the time. And then at certain panic points, it like kind of dives below it for very briefly when silver's like really climbing, like it did in 2011 or in 2020 relative to gold and stocks. So we're right at the line now, and we've been below it for a few months. If we can stay below this gold to silver ratio, below the 200-week moving average, we should start to see silver move seriously. And it seems that gold is at the end of a little bit of a correction here. And either there's going to be a debt ceiling deal or there's not, and that could be a trigger for something to move. If there's not going to be a deal, yeah, I think gold's going to explode, and so is silver. And if there is a deal, then the flood of treasuries could cause it also. But look, in the end game, we're looking, and I say this to my subscribers, we're looking for something between a 25 and a 15-to-1 ratio gold to silver in a true monetary panic, because the role of silver is as the ultimate gold substitute, right? When no gold substitute is trusted anymore and they don't work, there's no other way to buy things on a retail level. That's the only thing you could do. When gold is like $20,000 or $30,000 an ounce, we're not talking about a world where everything is basically normal, except it costs a little bit more to buy a wedding ring. Okay. It's something a lot different from that. It's a world where the money is falling apart. So because, again, I go to this all the time because of the monetary regression principle. You can't just create an array of prices out of nothing. It is impossible. Everything always has to be indexed to the past. And what is the past? Ultimately, the dollar it originated as a gold substitute, which means it still must be one. Because if it isn't one, then the entire chain from the past to the present falls apart and you have no prices of anything. So yeah, all these currencies moving up and down and stuff, when gold moving up and down is really currencies in their latter stages of life moving up and down because of the nature of fiat system. Which is now in the hyperinflationary stages, as Daniel Oliver points out, you don't have hyperinflation without hyperdeflationary scares, which is what forces the central bank to issue more and more currency every time, because if they don't, there's a hyperdeflationary crash, and that's what forces the curve vertical. That's where we are. Don't try to predict this exactly what's going to happen and be like a micromanager or microsurgeon of monetary markets. Just be humble, say you don't know, and make sure you got what you need. That's my approach. Interest rates are moving to 5.25%, 5.5%. Consumer price inflation looks like it has bottomed and it's going up again, especially we see this in the UK. Liquidity is being drained off, so that can't be sustained while keeping the current size of the pyramid intact. It's not possible, because the more money you print, the more financial entities exist that need more printed money to survive, and they become an integral part of the pyramid. So yes, eventually this whole thing is going to implode, and the Fed's going to have to reverse, just like they did in 2019, but in a much more extreme way, because there is an exponential curve here on the Fed's balance sheet that they have to meet that line, because money printing is an exponential exercise. It can't be anything but. And every time that the Fed balance sheet assets get off of that exponential curve, there's some kind of financial crisis, and they got to get right back on it. So they're testing the curve now. They're going to get back on it, and where they have to get back on it is much higher than it is now, because we're approaching the vertical line of this exponential curve. Mm-hmm. It's interesting that about housing. Here's the main difference as I see it from 2008. In 2008, the Fed owned zero mortgage-backed securities. Nobody knew even what a mortgage-backed security was. It was like George W. Bush had to get on the news and say, well, here's a lesson in mortgage-backed securities. And everyone was like, what's that? What are you talking about? And then everyone found out that, the banks, they don't hold on to your mortgages. They just shuttle them off to Fannie Mae and Freddie Mac, and they just hold all this stuff. And then they collapsed, and like, I didn't know how. Nobody knew that's how the housing market worked, except for some, people high up in Wall Street that knew about this stuff. Now everybody knows what a mortgage-backed security is and who owns them now. Who owns them? Not Fannie Mae and Freddie Mac. Who owns them now is the Federal Reserve. They own them. So if something is on the Federal Reserve's balance sheet, then that is the other side of the dollar, because one side of the Fed's balance sheet are the dollars that exist, and the other side of the dollar is everything else that's on the balance sheet. So meaning housing, which is the mortgage-backed securities, and the dollar are now two sides of the same coin. So if housing goes up, the dollar's purchasing power goes up, on a market cap, not an individual dollar. I'm not talking about individual dollar, but all dollars can theoretically purchase more than otherwise. You'll hear about falling housing prices and rising consumer prices at the same time. It doesn't seem to make sense, but that is what is going to happen, because the other side of the dollar, so much of it is mortgage-backed securities. I mean, I think like 40-50% of it or something like that. The rest is treasuries and some gold. What could really hurt the dollar and destroy its purchasing power is either a default on mortgage-backed securities, a default on treasuries, or both, because that's really what the dollar is by definition now. Right. So monetary forces on prices is just looking at the monetary side of a transaction. Right. There's two sides to every transaction. There's money and there's what you're exchanging for the money. So a monetary effect on prices would be the money supply expands, and therefore prices go up. Right. That's simple supply and demand. But on the other side, you have the non-monetary forces. When the money supply goes up, the effect is lowered interest rates, and lower interest rates allow more investment in capital projects. And the more capital you have invested in extracting commodities or whatever it is, you're going to have a higher supply of those commodities, and that is a non-monetary force from the supply of the non-monetary thing in the transaction. The price is going to fall. So over the long term, right, over the longer term, lower interest rates are paradoxically, they're going to lower prices for commodities because they're going to expand capital investment in the projects to extract more of them. But eventually the higher money supply over the longer term, you could say 10, 15 years, 20 years, whatever. I don't know exactly. Over that term, the money supply is going to catch up and cancel out any productivity gains in the supply of whatever commodity you're digging up from the ground. The monetary forces are going to trump the non-monetary forces pretty soon. And this is just another way to describe the end game or the hyperinflationary end game or whatever you want to call it. It's all the same way, different ways to describe the same elephant.